All right, now moving on to bond ETFs. So bond ETFs basically track bond prices. Now, if you don't know, what are bonds? Now, when you buy stock or equities, you're buying an ownership in a business. When you buy a bond, you're essentially lending money to a company and they pay you interest. So that's what we call corporate bonds. Now, you can also lend money to the government and the government pays you an interest rate. So those are known as government bonds, also known as treasury bonds. Now, for some reason, US government bonds are known as treasury bonds. But if you buy bonds from countries like Singapore or Turkey or whatever, they are called sovereign debt bonds, right? Just so you know. So usually if you like to buy a government bond, there's a minimum investment of about 50 grand to 100 grand. So some people may say, I can't afford that amount, but I want to invest in bonds. Well, the way to do it is through bond ETFs. So again, when you buy a bond ETF, it will track basically the bond index. And you've got long-term bonds, you've got medium-term bonds, and you've got short-term bonds. Personally, for me, I don't invest in bond ETFs because I tend to like to just focus purely on equity or stock ETFs, because in the long run, stocks would perform a lot better than owning debt. But some people say, I like to have a balanced portfolio, I like to invest in bonds, and by all means, you can buy the bond ETFs as well. So these are some of the common bond ETFs. You have got the TLT, and this is basically an ETF that tracks the 20-year treasury bond or the 20-year US government bonds. You also have the IEI that tracks the 5 to 7 year treasury bond, which is basically a medium-term bond. You can also invest in emerging markets bonds. So these are emerging countries that issue bonds. So for example, you have got the EMB, which is the emerging markets bond ETF. And you also have got the high yield bond ETF known as JNK. So basically, countries that are emerging markets, they will basically offer bonds that pay higher interest rate because these countries are more risky than developed countries like the UK or the US, right? So these are also known as junk bonds, and that's why the symbol sounds like junk, JNK. So normally, countries that issue junk bonds have high interest rates but are more risky because they may default on their debt. And what default means is that the country says, I can't pay you, I'm sorry, and then the bond goes to zero. So there's always a risk of that happening, right? And you can also invest in corporate bond ETFs like the LQD and the VSSH. So again, you can go to a charting software, key in the ticker symbol, and take a look at the performance of these bond ETFs over time. They do make money, they do have positive returns, but again, not as high as the stock or equity ETFs. One thing to pay attention to know, is that bond prices, they tend to move opposite of interest rates. Okay, so in other words, when interest rates, let me just draw this for you. When interest rates rise, bond prices tend to fall. Okay, and when interest rates fall, bond prices tend to rise. Okay, so that's a basic relationship between bonds and interest rates. Okay. All right, so from bond ETFs, we can go on to inverse ETFs. So what are inverse ETFs? These are special exotic ETFs that are created to move opposite of the underlying index. Okay, so many of these inverse ETFs are created by a company known as ProShares. PROSHARES. So it's a company called ProShares where they create these exotic ETFs. So what are they used for? They are used to profit when the index is going down, right? So obviously, when the index is on a downtrend, on a bear market, if you're holding the ETF, it goes down together. So you are seeing losses during that time. But if you say, hey, you know what, I want to make money, or the market goes down, you can buy an inverse ETF. So inverse ETFs are useful to kind of like hedge your long positions in your portfolio. So you may say, okay, I've got all these stocks that I've bought, I've got all these ETFs, and when the bear market comes and you choose to hold on to it, then during the 1 year bear market, you would see a drawdown in your capital. You would see the value of your ETFs going down. But if you buy the inverse ETFs, it will make money for you, and that profit would offset the temporary losses of your long positions. Or you can say, hey, during a bear market, I'm going to sell everything. I'm going to sell all my ETFs, my stocks, and instead I'm going to buy the inverse ETF so I can profit as the market goes down. You can do that as well. All right. So there are many inverse ETFs in the market. You've got the short Dow 30 ETF. It's known as the DOG, the DOG, the DOG. Okay. I'll show you the charts in a short while. You've got the short S&P 500 ETF known as the SH. You've got a short triple Q, which basically is an inverse of the NASDAQ. And you also have what is known as ultra short, which means that, for example, this is the SDS, which is the ultra short S&P 500. So what this means is that if the S&P 500 goes down by 1%, this ETF goes up by 2%. It double shorts the ETF. But on the normal short S&P 500, it's just one-on-one. So if the S&P goes down by 1%, the ETF goes up by 1%. So this is a great way to profit during a bear market, right? Now you also have got inverse ETFs on sectors. For example, you can buy the inverse technology ETF, the inverse financials ETF. So if that sector goes down, you profit from that movement, okay? You can also invest, or you can buy the inverse China ETF. So again, when China's on a downtrend, you're making money from that. So almost every asset has an inverse version. You also have got inverse bond ETFs known as the TBT. So it's pretty interesting, right? So with all these instruments, you can basically make money in any period of the market, whether the market goes up, goes down, or goes sideways at times. So here's an example from the charts. So you can see that during the financial crisis from October 07 to 2009, the Dow Jones, boom, collapsed 55%, right? It was a downtrend, it was a bear market. So at the time, what you could have done is the moment you recognize, hey, there's a downtrend, right? On the Dow's a downtrend, making lower highs and lower lows, the moving averages are sloping down, boom, you buy the DOG, the DOG, which is the short Dow ETF. So you can see that during this exact period, if you had bought the DOG at $52, as the market went down, boom, it's going up and you are making money. So really useful tool to have during a bear market. All right, so commodity ETFs. So these are ETFs that track a specific commodity or basket of commodities. So what are commodities? Well, you've got agricultural commodities like corn, or people call it maize. You've got sugar, you've got wheat, you've got soya beans, you have got coffee, right? So yeah, if you think that coffee prices are going up, you could invest in the coffee ETF, right? If you think sugar prices are going up, you could invest in the sugar ETF, or ETN is basically like an ETF, just slightly different, right? You can invest in the SGG, right? Or now you can also invest in things like natural resources ETFs like oil, okay? So during the oil crisis, right, oil crashed to $20. And if you watch my YouTube video, I said that oil has bottomed, oil would be recovering. So at that time, if you watch my YouTube video, you can check it out on YouTube. I said you can buy the USO or the UCO, and that basically tracks the oil prices. So when oil recovered from about $20 per barrel to now about $50, $60, I made quite a lot of money with that ETF. You can also invest in what we call a precious metal ETFs, like gold ETF, silver, and platinum, and so on and so forth. Okay. Now, generally for me, I don't invest in commodity ETFs per se, because if you look at the long run, commodity prices are very, very volatile. If you take a look at the DBC is a commodity ETF that invests in a basket of all the commodities. If you take a look at the last 10 years, it basically went sideways. Yeah. So there were certain years it went all the way up and then collapsed all the way down. So it's really volatile. I don't suggest putting it into your portfolio unless, of course, you're using it to hedge other assets. But there are times I may buy a specific commodity ETF if I feel that there's a special opportunity. So again, I mentioned two examples. One example is when I read that oil prices, had a sudden crash. This was about 4 or 5 years ago, right? From $100 per barrel, oil crashed to $20+ per barrel. It was oversold. And when I started to see the the trend beginning to reverse back up, I said, here's an opportunity. So I bought the oil ETF and made some good money as I rode the trend back up. An example is gold. Okay, so from the year 2000 to the year 2012, gold was on a very strong uptrend and bull run. So people who invested in gold made a lot of money. So when I saw the strong uptrend in gold, I said, I want to buy gold, but I don't want to buy the physical gold. So I bought the gold ETF known as the GLD. And I rode the trend. And finally in 2012, gold started reversing into a downtrend and I sold all my gold ETF positions. So how did I know that gold was going up? And how did I know it was going to reverse? I used a combination of fundamental understanding as well as technical analysis. So for technicals, I read the trend of the market. Again, when it makes higher highs and higher lows, right, I basically buy and I stay long in the market. When I see it reverse in a downtrend, making lower highs and lower lows, and I see the moving averages beginning to slope down, I start to exit my position. I also have an understanding of the fundamentals that drive commodity prices, right? So in general, you may want to know that interest rates are inversely proportional to gold prices, for example. So when interest rates fall, okay, the US dollar would depreciate. Okay, so what happens is that in the year 2000, we had the dot-com bubble burst and there was a recession. So during a recession, the government wants to stimulate more economic activity. So they cut interest rates. Now, when they cut interest rates, the US dollar starts to depreciate. Same thing, during the financial crisis, the Federal Reserve, they cut interest rates and they started printing more and more money, US dollars. So by doing that, the US dollar devalues. Now, when the US dollar goes down, guess what? Commodities like gold prices go up, right? So more specifically, gold prices tend to move opposite of the US dollar. Okay, so when US dollar goes down, gold goes up. Now, what happened was at about 2012, the US economy started recovering from the financial crisis. So when it started recovering, the Federal Reserve said, okay, enough rising interest rates. Enough cutting interest rates. We're now going to stop cutting interest rates and we're going to start raising interest rates, all right, in order to slow down the economy from growing too fast and creating inflation. So they say we're going to increase interest rates, we're going to stop the quantitative easing, which is stop printing money. And the moment that happened, guess what? Gold prices started reversing to a downtrend. So you need to have this knowledge of technical analysis and understanding how things are related, right, in order to capture these price trends. So I'll show you the chart in a short while. In fact, we can take a look at it right now. So taking a look at this chart of gold ETF, right? Again, this GLD, where is the gold ETF. And you can see that, let me just kind of like zoom out. There we go. So you can see that gold was on a very strong uptrend over here. There was a very strong uptrend because during this period of time, what happened? Right, the government was actually cutting interest rates and they were printing money to support the economy. And so the US dollar was going down and you can see gold prices were going up on an uptrend. Then in 2012, like I mentioned earlier on, they started to stop cutting interest rates. They started raising interest rates and the US dollar started appreciating. And you can see gold started to, boom, go on a downtrend. So currently, you can see that gold is on a downtrend. So now's not a good time to be in gold because it's on a downtrend and you continue to go down as long as the government, the US government, continues raising interest rates and the US dollar appreciates, okay? All right, so now that we've looked at all the different kind of ETFs, let's kind of like put it all together and let's take a look at something interesting. Notice that all these different assets, whether they're stocks, bonds and commodities, they don't move together all the time. In fact, sometimes when one is moving up, one is moving down. Let's take a look at a time period. So this is from 2007 to 2015. And what am I looking at? I'm looking at the S&P 500 ETF, known as the SPY. Okay, so again, this represents the US stock market equities. So you can see that the stock market was on a downtrend during the financial crisis, which was from 07 to 09, and it was on a very strong uptrend from 2009 to 2015, and to now, in fact, 2018. All right, so that's the stock market, right? Next, this is the TLT. And recall, TLT is the bond ETF, the long-term 20-year Treasury bond ETF. And you can see that during that period, that same period, bond prices actually rose all the way, okay? The next ETF is the IEI, which is the 3 to 7 year Treasury bond ETF, which also had a very clear moderate uptrend during that time period and returned about 5%, all right? The next is gold, right? So again, this is the gold ETF. Like I just mentioned, gold was on an uptrend all the way to 2012, and it then reversed into a downtrend where it is still today on a downtrend. And finally, this is the commodity ETF that basically invests in all the commodities, right? So this is the DBC, which is the commodity ETF. And like what I said earlier on, if you look at the last 10 years, it went nowhere, right? It went all the way up, all the way down, all the way up, all the way down, right? So if you held this by itself, it's a waste of time because it's very volatile. In fact, this ETF made minus 1% after 10 years, all right? Sucks, all right, by itself, okay? Now, what's my point? My point is, if you put all of them together, this is what they will look like, all right? So you've got the S&P ETF, you've got the bond ETF, the gold ETF, and commodity ETFs. Now, here's something interesting. Take a look at this period. If you look at 2007 to 2009, so this was during the financial crisis. What do you notice happened during the financial crisis? Notice that the stock market went down. And again, this is represented by the SPY, right? The SPY went down by 55%. But as the stock market was going down, what happened? What was going up? Notice that commodities, specifically oil prices and gold, was going up. Can you see that? And in fact, gold, which is this green line, also went up during the financial crisis because people were afraid of a financial crisis that they started buying gold as a safe haven. And during the financial crisis, you can see that both the bond ETFs rose steadily as well. So what's the point? The point is, during the financial crisis, if you had held a basket of all these assets together, right? You had stocks, you had bonds, you had gold, you had commodities, you would have created what called a hedge. What does a hedge mean? Hedge means when one goes down, the other goes up. So the one that goes up offsets the losses of the one going down. That's called hedging, okay? So some investors, they like to buy a portfolio of all these different assets. So it hedges each other. So in other words, the losses in the stock market would have been offset by the rise in commodities and bonds. So they get a net profit. Does that make sense? Okay. Now, then this period from, for example, 2012 to 2015, what happened? The opposite happened. This time, the stock market, which is the SPY, is going up like crazy. Can you see that? Stock market is going up, and bonds are also still going up, right? These two lines are going up. But what's going down now? This time, gold is collapsing. And the entire commodity ETF, which includes oil, is also collapsing there, right? So during this period, if you had held all these assets in a portfolio, what would have happened? That's right. The gains, or rather the losses in gold and commodities, would have been offset by the rise in stocks and bonds, thereby again hedging your position and giving you a slight profit. Okay? So later I'll share with you the different ways to construct a portfolio. One way is to just buy everything. And by buying everything, what happens is everything is hedged together. So when one goes bad, the other goes good, and you end up with a profit. But this method is, how do I say, it reduces volatility, but it doesn't give you a very high return, because when something goes up, there's always something pulling it down. See what I'm saying? So there's good and bad in this approach. So for me personally, I don't use this approach. I don't buy all the assets and I don't hedge. I tend to be a bit more aggressive. So for me, I just buy stocks. That's it. I just buy stocks. And so I just buy the SPY. And what happens is when the SPY is on a downtrend, okay, I basically at times just sell everything. I get out. So when it's going down, I'm not losing money. But I may buy the inverse ETF, which I mentioned before. So with the inverse ETF, as the stock market is going down, I'm making money. And once the stock market starts to reverse back into an uptrend, I get back and I buy back into the SPY again, and I ride the trend up again. And again, at certain times, I will enter the specific other ETFs. For example, if I see gold on an uptrend, I'll buy gold ETF. When I see gold reversing on a downtrend, I'll exit the gold ETF. So my approach is more of an active approach. I buy in downtrends. I buy during uptrends and I sell during downtrends. Or you could just buy and hold everything and let them hit each other. So you can see there are many approaches to the market. It depends. Do you want to be a more active investor or more of a passive investor? And again, we're going to talk about this in a short while on how do we enter and exit our positions. So with that, let me show you the next part of this lesson.